Welcome back, everyone. In our last video, we wrapped up our strategic launchpad in Module 1, where we analyzed how organizational architectures change corporate financial responsibilities. Now, as promised, let's step straight into Module 2 to master your core business vocabulary. We are kicking things off on slide 11 with the ultimate driver of any commercial enterprise: profit. In general management, we define profit simply as the financial excess of earned revenue over the costs incurred to generate it. But as corporate leaders, you must recognize two distinct profit classifications. First, we track revenue profits, which are your bread and butter earnings produced day in and day out from ordinary operations. Second, we track capital profits, which are one-off, exceptional gains realized from selling or exchanging business assets that aren't held for normal retail sale, like a company selling a piece of land or an old warehouse building. Moving to slide 12, we begin peeling back the layers of corporate profit hierarchies. The first layer is gross profit, or GP, which isolates the baseline profitability of your actual product or service before office rent, marketing, or interest expenses are considered. To find gross profit, you take your net sales and subtract the cost of goods sold, known as COGS. Think of COGS as the exact direct expense of acquiring or producing what you sell. The formula requires precise tracking. You take your opening inventory stock at the start of the year, add your raw purchases, subtract your closing stock at the end of the period, and add direct manufacturing expenses. These direct costs include factory labor, raw materials, and carriage inward, which represents the freight and transport fees paid to move materials from a supplier directly onto your production line. On slide 13, we step beyond trading margins to evaluate operational efficiency through operating profit, commonly called EBIT, earnings before interest and taxes. EBIT tells a manager how well the core business engine is running, regardless of how the company is financed or taxed. To calculate EBIT, we take sales revenue, add any minor secondary operating income, and subtract COGS, administration overheads, selling costs, and asset depreciation. Notice that bank interest is excluded here. When we do subtract interest expenses from EBIT, we arrive at net profit, or profit before tax. This PBT figure is the formal baseline upon which your corporate tax liabilities are evaluated. Finally, after corporate income tax is fully paid to the government, we are left with profit after tax, or PAT, the true corporate bottom line. Now let's look at slide 14 to see what happens to a company's profit after tax. This cash is split between corporate savings and investor payouts. Payouts are distributed via two types of dividends. First, the firm must pay a preference dividend. This goes to preference shareholders, who receive a fixed rate of return ahead of everyone else. Once preference claims are met, remaining funds can be distributed as an equity dividend to standard common shareholders at a variable rate. The money that management chooses to save rather than pay out is transferred into reserves. A revenue reserve is built out of regular revenue profits and can be spent on any expansion project the directors choose. Conversely, a capital reserve is built out of one-off capital profits. By law, capital reserves face tight regulatory restrictions and can never be used to distribute cash dividends to shareholders. Turning to slide 15, we shift our focus to the right side of the balance sheet to examine long-term liability and equity frameworks. The permanent funding foundation of any corporation is equity capital, collected by dividing ownership into small stock units. When establishing this, you must navigate four precise balance sheet terms. First is authorized share capital, which is the absolute legal limit of stock a company can register and sell under its memorandum of association. Second is issued share capital, which is the exact portion of that authorized pool that management chooses to offer to the market. Third is subscribed share capital, representing the fraction of issued stock that the public has formally agreed to buy. Finally, paid-up share capital is the actual cash that investors have transferred into the corporate treasury. This paid-up figure is the real capital base the business deploys to run its operations. Slide 16 handles corporate long-term debt instruments and short-term obligations. Beyond equity, a company can raise long-term capital through preference capital, which carries a fixed dividend rate and must be redeemed or repaid after a set timeframe. Another major tool is debenture capital, which is a secured long-term loan taken from the public at large. Debentures demand fixed periodic interest payments. If a company fails to pay, debenture holders can take the firm to court and force asset liquidation. We also have standard banking term loans, which provide secured funding for 5 to 10 years. For short-term tracking, we evaluate current liabilities, debts that must be cleared within 1 year, like bills payable, bank overdrafts, and trade creditors. Lastly, keep a sharp eye out for contingent liabilities. These are potential debts that might happen depending on an uncertain future event, like an ongoing court lawsuit. Because they aren't certain, they are left out of the balance sheet calculations entirely and are instead listed as footnotes below the statement. Let's turn to slide 17 and look at what the business owns to generate its wealth, its asset structures. Assets are categorized by time horizons, starting with fixed assets, which are held to produce goods or services rather than for quick resale. These are split into tangible fixed assets, which possess a clear physical identity, like land, plant, machinery, and commercial vehicles, and intangible fixed assets, which have no physical presence but hold massive economic value, such as goodwill, patents, and trademarks. For near-term operations, we manage current assets. These are assets safely convertible to cash or fully consumed within 1 year, including debtors, stock, and bank cash balances. If you need to assess immediate survival strength, you look at liquid assets. This is calculated by taking total current assets and removing slower-moving items like raw physical inventory and prepaid expenses. Slide 18 expands on asset deployment via corporate investments, where a firm parks capital outside its primary setup into government bonds, shares in other companies, or immovable property. When these are short-term and can be liquidated instantly in the open market, they are listed as marketable securities under current assets. However, as managers, you must understand a unique ledger entry called fictitious assets. Fictitious assets are not real assets and carry zero realizable market value. They are an accounting framework used to handle heavy upfront costs, like company formation expenses, historical business losses, or discounts given to issue shares. Rather than writing off a massive launch expense in a single month and destroying the profit statement, the company places it here and amortizes it gradually over several cycles. On slide 19, we look at how capital moves through 3 distinct expenditure frameworks. First is revenue expenditure, which includes the daily operational costs consumed entirely within the current accounting period to generate immediate revenue, such as stock costs, rent, and salaries. Second is capital expenditure, or CapEx, which represents cash deployed to acquire or upgrade long-term fixed assets. The economic benefits of CapEx always extend across multiple financial years. The third framework is deferred revenue expenditure. This occurs when an outlay is operational by nature, like a massive brand advertising campaign, but its positive financial impact is deferred because the benefits will roll in over several years. Until it is fully written off, it sits under fictitious assets and is systematically reduced year by year through amortization. Finally, let's wrap up our core terminology module on slide 20 by breaking down everyday operational metrics and trade tools. First, master the distinction between discounts. A trade discount reduces list prices for commercial volume considerations and never enters the formal account books, while a cash discount is officially recorded to incentivize immediate invoice payment. When handling returns, a business uses debit notes to notify suppliers that we are reducing what we owe them due to purchase adjustments, and credit notes to inform customers that we are lowering their account balances following a sales return. To build operational safety under conditions of uncertainty, we record provisions, allocating a degree of caution to cover expected asset falls, such as provisions for doubtful debts, before the exact values can be fully verified. This matches the ultimate structural health checks of any firm. Liquidity measures a company's agility in generating cash right when it is needed, while solvency tracks the capacity of the enterprise to honor its mature obligations on time. That brings our core terminology module to a close. In our next lecture, we are moving straight into Module 3, where we will ground ourselves in standardized global frameworks by exploring GAAP and decoding the structural differences between the accrual and cash bases of accounting. Don't forget to hit that like button, subscribe to Common Center, and drop a comment below letting me know which term you found most valuable today. See you in Module 3, and remember, just be yourself.